The deferred taxation is what you are looking at. And I will specifically look at this question that is quite easy, whose first requirement needs me to compute temporary differences. They want me to compute temporary differences. So temporary differences, ladies and gentlemen, how do we get temporary differences? Remember that to get temporary differences, to get TD, temporary differences, we normally take carrying amounts of an asset, carrying amounts as they are given in the balance sheet, for example. Carrying amount minus what we call the tax basis, minus what we call the tax base. So like, how do we get this carrying amount? To get the carrying amount, remember this is also known as what is the net book value. Net book value, what is in the books of accounts, what is in the balance sheet, right? Net book value, we normally take the cost of, if it's an asset, we take the cost of the asset minus what we call accumulated, minus accumulated depreciation, minus accumulated depreciation. That is how we get our carrying amount. You can write this in full. Carrying amount is net book value, which will always be obtained by taking the cost minus any accumulated what year depreciation. How do we get our tax base? Our tax base value will use the same cost that we have here. So it will be the cost, but now here we talk of what here. Remember, the taxman does not talk of depreciation. The taxman gives you a special allowance known as a capital allowance. So if it's 2 years, you accumulate. So in this case here, cost minus accumulated capital allowance, minus accumulated capital allowance. I know you guys are so good in computations of these capital allowances, industrial building deductions, isn't it? I know that is your forte, right? I know that is your strength. I know those are things you do in tax, right? But again, even if you have never done this tax, knowing that the taxman does not allow this. The taxman gives you what we call a capital allowance. Very important. I would want you to write this, and if possible, please highlight, knowing that CA stands for what here? The carrying amount. What value are we carrying this asset in our balance sheet, right? TB is the tax base. TB is a tax base. So are we together first of all up to here? Are we together first of all up to here? Are we together first of all up to here? Yes, yes. Thank you very much. Great. So now we can continue. Now what we need to do then to be able to get these temporary differences, we need to start straight away looking at this question. We are told Lamy Limited had a deferred tax liability as at 1st of May 2011 of shillings 100 million. For purposes of preparing financial statements for the year ended the 30th April 2012, the following additional information is available. We have a property, plant, and equipment. It has a carrying amount of 1,200 and a tax base of 1,000. Some land and buildings were revalued upwards by 50 million during the year ended the 30th April 2012. So then what I need to do, ladies and gentlemen, because I'm using the balance sheet approach, I'll need to come here and prepare two columns. So this is how my columns will look like. So we have here all my assets, liabilities, provisions, assets, liabilities. I'll have to capture them like that, right? And for each of these assets, I would want, ladies and gentlemen, their carrying amounts vis-a-vis their tax base. And then we have now the difference here is what we shall be calling the temporary difference, the temporary difference like that, temporary difference. Very easy, very easy, very easy. So we look for those assets. So the first one, they've told us it is property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment, ladies and gentlemen, they have already given me the carrying amount. So the carrying amount is 1,200. And the tax base, they have told me, is 1,000. So these are free mark. These are free mark. Difference means you're subtracting, right? Difference means you're subtracting. Difference means you're subtracting. So remember, the figures are given here. They've told us here, property, plant, and equipment has a carrying amount of 1,200 and a tax base of 1,000. So then what is the difference between the two? The difference, ladies and gentlemen, here will be how much here? the difference will be 200. It's positive, remember. 200, it's positive. Very good for me. Remember, to get temporary difference, we are taking the carrying amount minus what here? The tax base. The tax base, right? So it's positive. You leave it like that. Don't mention so much inside that it's positive. It's positive. Now, ladies and gentlemen, listen. Well, within this question, they have told us that we have a revaluation of the PPE, a revaluation of some PPE. This will not go into our temporary difference calculations. The revaluation of the PPE will go later on to part 2, when we shall be creating a deferred tax liability. So we are through with note number 1. Note number 2, intangible assets consisting of trade licenses being amortized over 5 years had a carrying amount of 60 million. This was allowed for tax purposes in full 2 years ago. That's very good for me. Very good for me. So then I don't have a problem with what? Carrying amount. The carrying amount of these intangible assets is 60 million. 60 is 60. So we have here intangible assets. So we have intangible assets. The carrying amount is what there? The carrying amount is 60. The carrying amount is 60. Right? And then the tax base, listen to me very well. The tax base, ladies and gentlemen, the tax base, they are telling us that they had allowed for this entire 60 for purpose of tax, meaning that this entire amount had been given out there as what here? Capital allowance. Listen, how do we get our tax base? Listen, to get our tax base, basically, we are taking the cost of the asset, minus what here? Somebody minus any accumulated capital allowance, minus any accumulated capital allowance, minus any accumulated capital allowance. So assuming in this case that this 60 was the initial cost of the intangible asset, right? Assuming. And then you are told that the taxman had given it out as a capital allowance. The taxman told this company regarding this intangible asset, go and claim everything. So it means that the entire capital allowance, ladies and gentlemen, was what here? Was 60. So meaning that the tax base now for future, the tax base automatically will be what here? Somebody will be 0. The tax base will be 0 there, right? The tax base will be 0. There is somebody who told me, Mwalimu, in this case here, intangible assets, you can even cram. The tax base is always what here? 0, apart from goodwill. But let us not get there. Let's not get there. I'll be able to go to goodwill and the other assets later. For now, listen the language here. What have they told us in this question? What have they told us in this scenario? What they've told us in this scenario is that this entire amount was allowed for tax purposes in full. It was given out by the taxman in full. So the entire capital allowance here was 60 million, right? So it will be 60 minus 60, giving me a tax base of what there? A tax base of 0. So then meaning that from the taxman's perspective, the asset is supposed to be valued at 0. And then from the accountant's perspective, when we are doing our balance sheet, we are valuing this asset at 60. So there is a temporal difference. At the end of the day, it must be corrected. There is a temporal difference. So the temporal difference is carrying us amount minus the tax base. So 60 minus 0 gives me how much here, somebody? This gives me 60 like that. This gives me 60 like that. Great. Let's go to the next item. The next item, ladies and gentlemen, they're giving us here is called who? Is called number 3. Look at number 3. The company has available for sale financial assets whose carrying amount is 20 and the financial assets at fair value through P&L of 10. Great. So I can see 2 assets here. So we have, ladies and gentlemen, financial assets. We have financial assets. Financial assets, we have financial assets, we have financial assets, we have financial assets, financial assets, financial assets, financial assets, 2 of them. We have financial assets, 2 of them. So we have financial assets, ladies and gentlemen, that are available for sale. Available for sale. And then we have got financial assets those ones which are short-term in nature, whenever we revalue them, we basically take the excess values to the profit and the loss. So in this case here, their fair valuation goes through profit stroke what here, somebody, through profit stroke loss. They've told us, ladies and gentlemen, something very easy here. What they've told us here is this. They've told us here that the company has available for sale financial assets whose carrying amount is 20 and the financial assets at fair value through profit and loss of 10. So fortunately, they have given me the two assets carrying amount. So 20 versus what here? 10. So we have 20 there versus 10. So these are the carrying amounts of these two types of financial assets. Great. Let's continue reading the question. So they're telling us, ladies and gentlemen, here that both financial assets reported losses in fair values of 2 million each as at 30th April 2022. Great. Listen and listen to me very well. The thing that I would want to do for these financial assets is to come here and ascertain their initial cost. Ascertain their initial cost. Listen here. We are saying that carrying amount equals cost less what here, somebody, less any accumulated depreciation. Less any accumulated depreciation. So when you look at these financial assets here which are available for sale, the carrying amount for this one has been given as 20. This has been given as 20. Ladies and gentlemen, the cost, I don't know what the cost is. I don't know what the cost of these financial assets is, but I know the accumulated depreciation, which is the same as the accumulated loss. I know in this particular year, it made a loss of how much here, somebody? It made a loss of 2. I'm not cooking these words from my mouth, ladies and gentlemen. These words are given here. They've told us here that for this, both financial assets reported losses in fair value of 2 million each as at 30th April 2012. Listen and listen to me very well. So we are saying that the loss, which is the same as depreciation of an asset, right, is 2. So can somebody give me this cost? Make cost the subject of the formula. If you make cost the subject of the formula, you will end up getting 20 what here, somebody? You'll end up getting 22. Please listen here. Once you get that 22, now come and give us the tax base. The tax base from now the taxman's perspective. The tax base will be the cost that you have gotten there, minus, of course, any accumulated capital allowance. So minus any accumulated capital what here? Capital allowance. So for these financial assets that are available for sale, right? Now I know the cost is 22, which I've gotten from here. The cost is 22. And we have not been given any information pertaining to any capital allowance being given or for the sake of what are these financial assets. We haven't been given at all. There is no place they're telling us that the taxman has given this capital allowance. So the better thing to do is to assume that the capital allowance is what here is 0. So meaning that the tax base for this financial asset which is available for sale will be how much here, somebody, if you're following? Will be how much if you're following somebody? If you're following, will be how much? Right? They're not talking to me. Will be 22. So basically what we have done is to add the loss back. We shall do the same for these other financial assets which are available, in this case here, not for sale, but which are going to be recognized. Their fair value will be recognized through profit and loss. They also made losses of 2. So 10 plus 2, this gives me what, somebody there? This gives me 12. Great. Now, ladies and gentlemen, listen and listen to me very well. So then this will be 20 minus 22. 20 minus 22, I can see a temporary difference of what here, somebody minus 2. The same case here, this will be minus what here, minus 2 there, like that. So here the trick was for you to get the cost of the financial asset. Students who are able to get the cost of the financial asset were able to handle the TB correctly. Were able to handle the TB correctly. Were able to handle the TB correctly, the tax base correctly. Now, please listen. So I'll be able to pick the next. I'll be able to pick the next. I'll be able to pick the next. I will be able to pick the next item. The next item here we are told is inventory. We are told inventory is shown at the lower of cost and net realizable value. The cost is shillings 800 million, while the net realizable value is 780. Listen. Inventory is very easy to handle it as pertains IAS 12. Inventory. So inventory carrying amount is always the same as what your net realizable value. Carrying amount is the same as net realizable value. Remember here, what are you supposed to recall, ladies and gentlemen? It's IAS 2. So IAS 2, we are told in this case here to pick. We are told in this case, ladies and gentlemen, to pick whenever you're looking at inventory valuation, the value to pick here. The value to pick here. Allow me to explain this a little bit. IAS 2 tells us to look at the cost of the inventory versus in this case here what we call net realizable value. So the cost here is 800. The net realizable value is what here? Somebody is 780. Is 780. And then you should pick in this case here the lower always. So in this case here, to explain this better to you, inventory's carrying amount in our books will be 780, yeah? And then now we need to come and look for the tax base of this inventory. How do we get the tax base? To get the tax base is a simple thing. To get the tax base, ladies and gentlemen, is a simple thing. To get the tax base, this is what we normally do. To get the tax base, we'll take the cost, always the cost, minus the accumulated what here, capital allowance, minus the accumulated capital allowance. So the cost of this inventory is 800. For those of you who are doing taxation at the moment, have you ever seen the taxman giving capital allowance for inventory items? Have you ever seen the taxman giving allowance, capital allowance for inventory items? Have you ever seen that? Have you ever seen that? No, capital allowances are for warehouses, factories, right? Even motor vehicles, they come into the capital allowances here according to the classes, if you remember, right? It's not inventory items. So always the accumulated capital allowance for inventory is zero, meaning that the tax base there will be what here will be 800. The tax base there will be 800. So what is 780 minus 800? What is 780 minus 800? Can somebody give me this figure? 780 minus 800. Can somebody give me this figure? I'm coming to the end of this now. 780 minus 800 gives me minus what here? Gives me minus 20 like that. So that is inventory. That is inventory. Now, ladies and gentlemen, after you clear with this, now we should be able to do the last item. The last item here is known as a trade. No, we have receivables still. Sorry, we have receivables. We are told receivables had a carrying amount of 500. Let me first of all recognize that is a free low-hanging fruit, low-hanging mark. Let me recognize this receivable carrying amount. Receivable carrying amount. So we have a receivable carrying amount. We have receivable carrying amount. So we have receivables carrying amount. So receivable carrying amount, ladies and gentlemen, that we have here is 500. Is 500. Is 500 like that. So, and then they proceed telling us there that receivables had a carrying amount of 500 million after making an allowance of doubtful debt of 20 million and an exchange gain of 40 million. Both the allowance and exchange gain are not allowed for tax purposes. Very easy for me. Very easy for me. Very easy for me. Because if this is the carrying amount, then what I need to do is to come and get the cost. For me to get the TB, I would need to know the receivables cost, in quotes, the receivables quotes, that original value. So in this case here, what do? I know the formula of getting carrying amount. It is the cost minus any accumulated what year depreciation. That is the general one. So the carrying amount given for receivable is 500. Is 500. I have to write this in a different place. So the carrying amount here is 500. The carrying amount here is 500. The carrying amount here is 500, which will be equal to the cost. We do not know the cost. We don't know the cost. But they have given me some losses. They have told me there is a loss. There is a loss of how much? They've told me there is a loss of how much? They've told me there is a loss. There is a loss. The receivables are the carrying amount of 500 million after making an allowance for doubtful debt of 20. So this is a loss, 20. So minus 20, it's a loss. Reduce the cost here. And then, ladies and gentlemen, still on the same length, we have got what here? We have got a gain. A gain of how much? A gain of 40. So of course, gain will improve on our initial. So gain should be plus 40 like that. So can a good student in this case here then make cost the subject of the formula? Can a good student here make cost the subject of the formula and give me the cost amount? Give me the cost amount. 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 So Lily is telling me it's 560. Please use body mass. Use body mass. Use body mass very well. Use body mass very well. Use body mass very well. Right? So if I'm the one doing this, first of all, I'll come and mention here 500 equals cost minus 20 plus 40. Minus 20 plus 40, if I use my calculator very well, this will be positive 20. When I cross this over to the other side, then cost will be 400 what here? Cost will be 480. And once now you get the cost of this thing, it's very easy for you to get the tax base. So to get the tax base, what I'll do here, to get the tax base, I will take the cost minus any accumulated what here? Capital allowance. Minus any accumulated capital allowance. So the cost, ladies and gentlemen, here is 480. We have been told that there is nothing there is nothing there that the taxman is allowing. The taxman is not allowing anything there. He's not giving us any allowance there. So the accumulated capital is what here? Capital allowance is 0. So therefore, the tax base in this case here will be what somebody we are following. The tax base here will be what here somebody? The tax base will be what? The tax base, the tax base. Somebody give me the tax base. So basically we are remaining with the 480. And then I'm seeing Paul asking, why are we subtracting? Why are we subtracting? But you see, if for example, you're told that the original cost, the original receivable is, for example, is 500. For example, let me use a different figure so that it doesn't confuse you. If you're told that the original receivable is 1,000, for example, and then you are told that there are some receivables you don't expect to receive anything from them, give a provision for that. So give a provision of say 100. You see what will happen there? You subtract any provisions for doubtful debts. You subtract. And of course, in the future, should you expect to gain something, what do? You add the gain, you subtract the loss. You add the gain, you subtract the loss. How do you do it in practice? How do you do this in practice? How do you do this in practice? They have told you here, receivables are the carrying amount of 500. Remember this carrying amount, it's not cost. After making an allowance for doubtful debt of 20. So of course, they subtracted this 20 to get this 500. So to make good, I'm supposed to add back the 20. And then of course, the gain, you do what you subtract. But in practice, we like, ladies and gentlemen, in practice, I told you, I practice. That's the only thing I do in life. I practice financial reporting at my place of work. We do these standards intensively. I don't do any other thing. Every time it's IAS 12, it is IAS 39, etc. IAS 19, like that. Right? So in practice, this is how we look at it. Right? We do it slowly using like SAP. We do them slowly until we appreciate everything. So that is receivable. So first of all, up to there, are we together up to here? Up to here, are we together? Are we together up to here? Right? Are we together? Are we together? I can see Rosie saying yes. Scholastica, yes. So now we go to the last one. So the last one, ladies and gentlemen, that we have here, ladies and gentlemen, the last one that we have here is number 6. So number 6, you are told the trade and other payable are stated at 900 million after making provisions for discounts of 10 million. Trade and other payables are stated at 900 million after making provisions for discount of shillings 10 million. So the first thing that I need to appreciate here, which is a low-hanging fruit, is to come and look at carrying amount of the trade. payable. So the trade payables carrying amount there is not in doubt. The carrying amount of this trade payable is 900. Is 900. So I need to come and recognize that the payable here and put 900 there. The payable here and put 900. So we have the payable. So we have the trade payable. The carrying amount, this is not in this, it is never in dispute. So the carrying amount, ladies and gentlemen, trade and other payables are stated, they're stated in our books. Net book value is 900. And this is after making a provision for discount of what here, 10 million. So of course I can do this very fast without writing very many formulas, but just to show you what happens, you see, how do they get this carrying amount? For them to have gotten this carrying amount, this is what they did. This is what they did. They took the cost minus, in this case here, the provision minus that loss which was being provided for. So to get the carrying amount of 900, in this case here, we don't know the cost, but fortunately we know the loss that was suffered, the loss which used to be suffered. So the loss is how much here, somebody? The loss is 10. The loss is 10, right? The loss is 10, right? So meaning, ladies and gentlemen, that the cost here will be 900 plus 10, which gives me 900 and what here? 910. 910. Now it is out of this. Actually, you guys are lucky because your examiner does not really test hard questions in terms of what a deferred tax. Your examiner gives you very easy things, right? Because if this examiner was a good examiner, now you should have brought in something to do with capital allowance here to ensure that the tax base at least has to be computed. It should not be fairly obvious. So automatically, because there is no any capital allowance, so automatically we are saying here that the tax base is what here? Is 910. And then remember that this is a liability. When it's a liability, we have to capture them in brackets like this. When there are liabilities, we must capture them in brackets like that. And then I'll come and subtract the two. So when you're subtracting the two, you have to be very keen. It is minus 900. There is a minus for subtraction. And then this figure itself is minus 910. So could you kindly give me this? Minus 900 plus 910. What figure do we have here, somebody? This, of course, is 20 positive. And this, I believe, will be 10, isn't it? So then could you kindly give me the total temporary difference? Give me the total temporary difference. Please add everything. Add everything. 10 positive, yes, Scholastica, 10 positive. Now add everything, add everything, add everything, and give me the total temporary difference. They're giving me 266 positive, isn't it? So meaning that it is a taxable temporary difference. You're going to be required to pay tax on this. It's positive, eh? It's positive. So it's a taxable temporary difference, which gives birth to what we call a deferred tax liability. So go ahead and give me the deferred tax liability. Go ahead and give me the deferred tax liability. Go ahead and give me the deferred tax liability. So give me the deferred tax liability. So how do we get this deferred tax liability? We shall take the 30% multiplied by the total temporary difference, which Rosie is giving me a figure of 79.what here? 79.8. So in the financial year, this becomes balance carried forward. In the current financial year, this becomes balance carried forward. It becomes current, or rather balance carried forward. So when I'll be doing my T account, this is what I shall end up getting. When I'll be doing my T account, this is what I shall end up getting. So when I do my T account, this is my deferred tax liability. I'll have here balance brought down, and then I'll have here balance carried forward there. So the balance carried forward for this financial year will be 79.8 like that. Right. And then remember at the beginning of the year, we had, ladies and gentlemen, at the beginning of the year, we had some tax being brought forward. At the beginning of the year, we are told here Lamy Limited had a deferred tax liability as at 1st May 2011 of shillings 100 million. So this is what was brought forward at the beginning of the year. So deferred tax liability brought forward is 100, is 100 like that. And then now you look for any information as regards to what year revaluations of your future assets. Long-term assets. Whenever you revalue long-term assets, then there must be a direct impact on this DTL account. So like now here, ladies and gentlemen, they gave us something very important here. In note number 1, they told us that some land and buildings were revalued upwards by 50 million. So if it's an upward revaluation, that will increase our liability. We'll be told here to pay something. If it's an upward revaluation, that of course creates what here? A deferred tax liability. So then we'll come and give us here PPE revaluation. 50 million, so times 30%, which gives me what here? Somebody 15, which gives me 15 like that. Is a PPE. PPE is long-term asset, which was revalued. That must hit my deferred tax liability account directly, without passing a journal, without passing the information through what here? Through my temporary differences. Great. Do we have any other thing in this case here that will hit here? Any other asset that was revalued in the year? Any other asset that was revalued in the year? Any other asset that was revalued in the year? Is there somebody who is able to see any other asset that was revalued in the year? Any other asset that was revalued in the year? Any other asset revalued in the year? Any other asset revalued in the year? I'm waiting to hear from you guys. Yeah, great. You guys are right. So loss on this available for sale. You guys are very bright. Loss on this available for sale. Financial asset that is available for sale. That loss that you make there, automatically it shall be cancelled. It shall reduce our deferred tax liability. So you're right. So any loss that you make out of these financial assets which are available for sale. Remember, you have declared they're available for sale. So whenever you make a loss, the taxman will allow that loss, right? You reduce your tax liability. So we have here loss on fair value of available financial what here? Assets. The financial assets, remember we have some financial assets, ladies and gentlemen. The financial asset here, this financial asset here, this available for sale. Available for sale financial assets. Whenever you make a loss on them, the taxman will really allow you to enjoy some tax there. So in this case here, what is the loss? The loss is 2 million. Please don't bring the financial assets whose fair value is adjusted through profit or loss. Those are short-term. The taxman cannot give you an allowance for that, right? So in this case here, loss on fair value available for sale is 2 million. So of course, in this case here, times 30%, which gives us 0.6, and that is it. So come straight away and make adjustments. Come in this case, ladies and gentlemen, and give us the balancing figure. So I can see this 115. This 115. 115 is bigger, right? So what is the difference? Here, can somebody give me the balancing figure? Somebody, 115 minus this. Is there somebody who can give me the balancing figure? Is there anybody who can give us the balancing figure? Right, 34 point what here? 34.6. So this 34.6, what do we do? This is what we take to our income statement. This is what we take as an income arising out of what here? Our deferred tax liability. our deferred tax liability, 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 right? So of course, in this case here for this 34.6 journal will be that you debit the deferred tax liability account, you debit the deferred tax liability account, you debit the deferred tax liability account, you debit the deferred tax liability account with 34.6, and then you credit the P&L. You credit the P&L account. In terms of deferred tax liability, we shall always ignore the short term. Remember these financial assets which are available through whose revaluation goes through the P&L, we ignore them whenever we are computing this deferred tax or liabilities. We ignore them like that. So now, ladies and gentlemen, we have come to the end of this particular session. But now remember, all in all, you're supposed to appreciate these small shortcuts. The small shortcuts here. The small shortcuts, like now here we are being told trade and other payables are stated at 900. You know that this is the carrying amount, isn't it? This is the carrying amount. After making provision for discount of 10, so you know straight away that the provision that you are making here, the provision that you are making here of 10, ladies and gentlemen, of course, the taxman does not allow for provisions. So to get the tax base, you add back, right? You add back. So those are the kind of shortcuts that you're supposed to appreciate, which you should be able to do, and then ensure that you become so good for you to appreciate, of course, the concept of what year, temporary differences, IAS, what year, IAS 12. IAS 12. So I shall be able to upload this video on YouTube, and please, anytime you see my YouTube videos, ensure that you share them, you subscribe, right? So that's what I wanted to do for this lesson. So the lesson is over. You guys now go for other sessions. Thank you very much. Bye-bye. Bye-bye. And it's my belief that you guys have gained some